Moving on to other news now, and all eyes are on the Reserve Bank today, with many economists predicting another interest rate cut on the cards. This would be the first back-to-back reduction since the pandemic and the third this year.
So what will this mean for both mortgage holders and savers alike? For more, economist Evan Lucas joins us live in Melbourne. Great to have you with us again. Well, time to get out the crystal ball. What's your predictions for today's meeting?
Morning, Sherbo. Look, the prediction today is more about what the market is telling us. It's a 95% chance, according to the market, and 88% of economists surveyed out of 30 predict that there will be a cut today. As you said, it will be the first time we've seen a back-to-back move, either up or down, since the start of also, I'd actually point in what's gone on with the cost of living crisis. It would also mean that for a $600,000 mortgage loan, another $90 comes out per month, which would mean, since the start of this year, it's been a $270 monthly reduction.
I notice there are some economists saying that they may wait another 5 weeks for CPI data.
Yep.
Do you think that's a possibility, or they're just in the minority?
They're in the minority now. It is a possibility. So the reason we've seen such a move up to see this meeting rather than the August meeting where that data comes through is that core inflation, so that's trim mean inflation, at the last two reads is now at the lowest it's been since 2021 at 2.4%. That's below the midpoint. It's faster than forecasted. In fact, they didn't see this happening till the end of the year. So yes, there is that chance to get all of that data in. But the data alone, 60% of it, is telling us that we're probably there now. The concern they'd have is that it actually falls below target and falls below 2%. That's why they might need to move now rather than waiting an extra 5 weeks.
Evan, there's a lot of articles at the moment about the end of the cost of living crisis. I mean, how do you determine that, and what does that actually mean?
Yeah, that's a great question, Sherbo. So I want to point out that in terms of the cost of living, it hasn't changed. I mean, you can still look at pretty much everything. They are at the same prices they were pretty much at the start of the year. The difference is they're not growing at the same rate. So I would argue that the cost of living hasn't gone away. It's just not rapidly increasing like we saw through 2023 and 2024. Yes, the pressure on the household is less because, as I said, that $600,000 mortgage maybe by the end of today is $270 less than it was. But the cost of goods is not decreasing. We don't have deflation. We have what we refer to as disinflation. We still have inflation, but it's not growing at the same level. So that is why we are still seeing people trying to save, trying to basically crimp and still look for basically the best opportunities they can with the money that they have.
Yeah, it just still feels so expensive out there because it is. OK, what about savers? How's this going to affect them?
Well, savers, we know, have already been the ones hit hardest. I mean, they were moving savings rates before they moved in February, Nat. So, again, it means that that term deposit or that cash rate money that you have is getting lower and lower. It'll probably mean that savers have to look to other opportunities to try and recoup the loss that they're going to get because the money invested isn't going to return what it was this time last year.
Thank you so much, Evan. Really interesting, and we'll get you back on once we do hear that deliberation and, of course, what they're going to do with cash rates today, the RBA. So interesting, isn't it? Because, you know, everyone's in a different position. So you can't just blanket say, well, the cost of living crisis is over, it's good for savers, it's good for borrowers. You know, it affects everyone in a different way.
Except things are just exactly, like you said, just as expensive as they were yesterday.